The U.S. government just crossed $39 trillion in national debt. The interest payments on that debt, just the interest, not the actual debt itself, now exceed $1 trillion per year. That's more than the entire defense budget, more than Medicare. It's the third largest category of government spending, sitting behind only Social Security and Medicare. And it's growing faster than any tax cut or spending reduction can touch it. Here's what I want you to understand about that number. It is not just a fiscal problem, it is the symptom of something much bigger that has been quietly breaking down for years. And that breakdown is now accelerating in ways that will affect every person with a retirement account, a savings account, or a pension. Most people look at the situation and see a debt crisis. What's actually happening is a monetary system in transition. The engine that funded American spending for 50 years, that kept interest rates low, that made mortgages cheap, that allowed the U.S. to borrow from the entire world at discount prices, is shutting down. That engine is called the petrodollar system, and understanding why it's ending and what replaces it is the most important financial story of this decade. Let me walk you through it. No jargon, no complexity. Just the mechanism, the data, and what it means for your money. To understand what's breaking down, you need to understand what was built. After World War II, the dollar was backed by gold. Every dollar in circulation could theoretically be exchanged for a fixed amount of physical gold held in U.S. vaults. That system was called Bretton Woods, and it created remarkable financial stability for about 25 years. But by the early 1970s, the U.S. was spending more than it had on the Vietnam War, on massive social programs. The government was quietly printing more dollars than it had gold to back them up. When France and other countries figured this out and started demanding their gold back, the system cracked. In August 1971, President Nixon ended the dollar's convertibility to gold. The dollar became a currency backed by nothing physical, only by trust in the U.S. government. That created an immediate problem. And without gold backing the dollar, why would the rest of the world keep accepting and holding it? The answer came 3 years later, in 1974. Secretary of State Henry Kissinger struck a deal with Saudi Arabia. The Saudis would price all their oil exports exclusively in U.S. dollars. They would take the dollar surpluses they earned and recycle them into U.S. Treasury bonds. In return, America would provide military protection, security guarantees, and ensure free passage through the Persian Gulf. The rest of the major Gulf oil producers followed. And overnight, a new anchor for the dollar was created. Not gold, but oil. Think about what this meant practically. Every country in the world needed oil. Every industrial economy ran on it. And to buy oil, you needed dollars, which meant every country on earth had to hold dollars. And the most useful place to store dollars was U.S. government debt, treasury bonds, which paid interest and were considered the safest asset on the planet. This created something extraordinary. Structural, permanent, global demand for U.S. dollars and U.S. treasury bonds, not because countries particularly wanted to fund American spending, but because they had no choice. It was the price of participating in the global energy market. That arrangement funded American deficits for 50 years. It kept U.S. interest rates lower than they ever would have been otherwise. It kept mortgages cheap. It allowed the U.S. to run trade deficits that would have destroyed any other country's currency. Economists called it America's exorbitant privilege. That privilege is now ending. Most commentary on the petrodollar's decline focuses on external threats. BRICS nations trading in local currencies. China signing yuan-denominated oil deals with Gulf states. Russia and India settling energy trades outside the dollar. Those things are real, but they are consequences, not causes. The actual cause is something that barely gets discussed, and it changes the entire picture. The United States is now the world's largest oil and gas producer. It surpassed both Saudi Arabia and Russia. America is a net energy exporter. It no longer needs the Persian Gulf the way it did in 1974 when Kissinger made the original deal. When the original petrodollar bargain was struck, the U.S. had a powerful reason to provide military protection to Saudi Arabia. American energy security depended on it. That enforcement incentive, the willingness to garrison the Gulf, to protect the Strait of Hormuz, to subordinate foreign policy to Middle Eastern energy stability, was what held the whole system together. When that enforcement incentive weakens, the system it was designed to maintain starts to loosen. And it has already started. In 2024, Saudi Arabia quietly did not renew its commitment to price oil exclusively in dollars. The 50-year informal arrangement that began in 1974 simply expired without renewal. Saudi Arabia has since formalized a defense partnership with Pakistan, replacing the American security guarantee with a different arrangement entirely. It has participated in pilot programs for multi-currency payment systems, including Project mBridge, a digital payments platform that allows cross-border transactions without dollar intermediation. This doesn't mean Saudi Arabia has abandoned the dollar. As of today, the vast majority of oil is still priced in dollars. The shift is gradual, but the direction is established, and the mechanism driving it, America's changed energy position, is structural and permanent. As the dollar analyst community notes, the glory days of the petrodollar are over. What's being lost isn't just a pricing convention. It's the structural engine of demand for U.S. Treasury bonds that kept American borrowing costs low for half a century. Here is where this gets personal. The petrodollar recycling mechanism was the single biggest source of demand for U.S. Treasury bonds for 50 years. Foreign central banks and sovereign wealth funds held dollars because they needed them for oil purchases, and they parked those dollars in treasuries because that was the safest, most efficient place to store them. That demand kept Treasury yields, the interest rate the U.S. government pays to borrow, lower than they would otherwise have been. Lower government borrowing costs flowed through the entire economy as lower interest rates on mortgages, car loans, business debt, and everything else the last 5 decades of American financial life were built upon. Now that structural demand is contracting, and the consequences are arithmetic. Net interest payments on the national debt are projected to exceed $1 trillion in fiscal year 2026, nearly triple the $345 billion the government paid in 2020. As total U.S. national debt ticks over $39 trillion, the government paid out $529 billion in interest payments alone in just the first 6 months of the current fiscal year, more than $88 billion every single month. Interest expense now exceeds $1 trillion annually, surpassing both the defense budget and Medicaid individually, and ranking third among all federal expenditure categories behind only Social Security and Medicare. Let that sit for a moment. The U.S. government now spends more money just paying interest on old debt than it spends defending the entire country. And this number is not going down. The CBO project's deficit's growing to $3.1 trillion by 2036. Every dollar of that deficit requires issuing more debt. More debt means more interest. More interest means more debt. This is a compounding loop that has no self-correcting mechanism. Now here's the part that directly affects ordinary investors. Many people in their 40s, 50s, and 60s hold significant amounts of bonds in their retirement accounts, often without fully realizing it. Target date funds, balanced funds, bond funds, these are standard components of most 401k portfolios, designed to be the safe portion of a retirement strategy. The problem is that bonds work in a specific way. When yields rise, bond prices fall. And if Treasury yields need to rise structurally, not just cyclically, to attract buyers as petrodollar recycling contracts, long-duration bonds face years of headwinds regardless of what the Federal Reserve does with short-term rates. Large and rising fiscal deficits and increasing issuance of U.S. Treasuries means that more and more buyers need to step up to help fund government spending. When the buyer base that sustained low yields for 50 years is shrinking, the yield has to rise to compensate. That is not a forecast. That is supply and demand. The person who thinks their bond-heavy retirement account is safe because it has always been safe is measuring safety against conditions that no longer exist. There is a second dimension to this story that almost no mainstream financial commentary is covering, and it points to where the next major capital opportunity may be forming. The United States is executing the most significant geographic reorientation of its economic and strategic posture in a generation. The direction of that pivot is not toward the Middle East. It is inward, toward the Western Hemisphere, toward closer supply chains, toward resources that don't depend on shipping lanes 12,000 miles from home running through contested choke points. You can see this playing out in the shift in attitude toward Venezuela, a country with the world's largest proven oil reserves, and a grade of heavy crude that Gulf Coast American refineries were specifically built to process. You can see it in the U.S. hosting its 2026 Critical Minerals Ministerial, committing billions in financing to secure cobalt, nickel, copper, and rare earth supply chains from Australia, the Democratic Republic of Congo, and Pakistan. The U.S. Export-Import Bank has issued $14.8 billion in letters of interest for critical minerals projects under the Trump administration, including $455 million for rare earth development and processing in the United States, $400 million for lithium extraction in Arkansas, and $350 million for cobalt and nickel production in Australia. This is not aid. This is strategic positioning for a resource competition that China has been winning for 20 years. China currently controls approximately 60% of global rare earth processing capacity. It has systematically secured cobalt supply through investments in the Democratic Republic of Congo. It has moved aggressively into nickel in Indonesia. The competition for critical mineral supply chains, cobalt for battery cathodes, nickel for electric vehicle drivetrains, copper for every data center and charging network, rare earths for the magnets in wind turbines and advanced weapon systems, is the defining resource contest of this decade. And sitting 90 miles off the Florida coast is a piece of that puzzle that has barely been touched in 60 years. Cuba holds some of the largest nickel and cobalt deposits in the Western Hemisphere. Cuba ranks as the world's 9th largest producer of nickel and 5th largest producer of cobalt, and holds cobalt reserves estimated at 0.5 million tons, the 3rd largest cobalt reserves in the world after the Democratic Republic of Congo in Australia. It also holds significant copper and chromium resources. In the 2026 geopolitical environment, the Cuba question has become a multi-layered global power struggle at the intersection of ideology, energy security, and competition over battery raw materials. The country has been cut off from international capital markets for over 6 decades. Its mineral deposits are dramatically underdeveloped as a direct result. If political conditions change and American and allied capital flows into Cuban mining infrastructure, it would represent one of the most significant undeveloped resource openings in the Western Hemisphere. I am not predicting when or how that political shift happens. What I am saying is that the strategic logic, Western Hemisphere resource security, competition with China over critical minerals, the decline of the Gulf as the center of American strategic attention, all point in a coherent direction. And the historical pattern of how these transitions play out, investment attention arriving before political clarity, is worth understanding. Let me bring all of this down to the level that actually matters to most people watching this. 3 things are happening simultaneously, and they interact with each other. First, the dollar will face sustained long-term downward pressure, not a collapse. The dollar remains the dominant global reserve currency and will not be replaced quickly. But the structural demand for dollars that the petrodollar system created, the fact that every oil-importing nation had to hold and recycle dollars, is weakening. Less structural demand means a gradual, persistent decline in the dollar's real purchasing power over time. The dollar's share of global reserves has fallen from 72% in 2000 to roughly 58% in 2026. That decline didn't happen overnight, and it won't reverse overnight. But the direction is one way. What does a weakening dollar mean for you personally? It means everything you buy that is sourced internationally, electronics, clothing, food, fuel, gets more expensive over time. It means your savings account, denominated in those dollars, loses real purchasing power even when the number in the account stays the same. Inflation is the visible symptom. Dollar depreciation is the underlying mechanism. Second, long-duration bonds face structural headwinds for years, not months. The bond portion of your retirement portfolio was priced into a world where petrodollar recycling created permanent excess demand for U.S. Treasury debt. That world is changing. Rising Treasury yields are not a temporary blip that will reverse when the Federal Reserve cuts rates. They reflect the genuine need to attract a new, smaller buyer base for a much larger supply of debt. If you have a significant allocation to long-duration bonds in your retirement account, understanding the difference between cyclical and structural interest rate risk is not optional anymore. Third, real assets and critical mineral exposure are early-stage opportunities. When the monetary anchor that suppresses commodity prices loosens, as it did after 1971, when gold went from $35 to over $800 per ounce in less than a decade, the assets that are physically scarce reprice. Gold, silver, copper, nickel, cobalt, productive land, these cannot be created by a government printing press. Their supply is constrained by geology and capital investment. Their demand is driven by the electrification of the global economy, the AI infrastructure build-out, and military technology competition that is only accelerating. The companies developing critical mineral supply chains in the Americas, in Africa, in allied nations are in an early phase of what is likely a multi-year demand story. The gap between the certainty of long-term demand and the years it takes to build supply is where patient investors have historically found the most significant returns. Every major monetary transition in history has produced the same split. There are investors who understand the mechanism underneath the headlines, who see not just what is happening, but why it is happening and what direction it points. And there are investors who stay positioned for a world that no longer exists, who assume the future will look like the recent past because the recent past is all they have experienced. In 1971, when Nixon ended the gold standard, the investors who understood that removing the constraint on dollar creation would eventually drive hard asset prices higher bought gold at $35 an ounce. By 1980, it was over $800. Not because the world ended because the monetary anchor that had suppressed its price for 25 years was gone. When the petrodollar system was constructed in 1974, investors who understood that it would create sustained demand for U.S. financial assets and suppress commodity prices for a generation positioned in dollar-denominated assets at exactly the right moment. We are now at a comparable inflection point. The system that created structural demand for U.S. treasuries, kept bond yields artificially low, and suppressed commodity prices for half a century is in structural transition. The transition is gradual. These things always are until they suddenly aren't. But the direction is established. The data confirms it. The behavior of central banks buying gold at record pace confirms it. The U.S. government's own interest payment numbers confirm it. The strategic repositioning toward Western Hemisphere resources confirms it. I want to end with something simple. Most people will watch this video, nod along, and then go back to managing their finances exactly the way they always have. checking the balance in the savings account, leaving the 401k in whatever default allocation it came with, trusting that what worked for the last 30 years will work for the next 30. That instinct is understandable. But it is dangerous in a period of structural monetary change. The last 50 years of American financial life were built on specific conditions, cheap borrowing enabled by petrodollar recycling, a strong dollar anchored by global oil demand, and stable bond yields that made fixed income genuinely safe. Those conditions are changing. The people who adjust to the new conditions before they become obvious in prices will look back on this period the way long-term gold holders look back on 1971. Not as a crisis they survived, as an opportunity they recognized early enough to act on. The petrodollar era built enormous prosperity. There's real loss in watching it fade. But understanding why it is fading and where capital flows next is how you protect what you've built and position for what comes. That is the honest picture of where we are right now. If this gave you a useful framework for thinking about your financial situation, subscribe. I will keep tracking these structural shifts carefully and sharing what I see as clearly as I can.